And joining us from Washington, D.C., we have Omer Esiner, Chief Market Analyst at Commonwealth Foreign Exchange. Omer, good to have you with us. Let's talk about the Bank of Japan decision first off. Some are calling it a surprise. Not many had predicted this move. But what do you think this means when borrowing costs are virtually at zero in the world's third biggest economy?
Well, I wouldn't call it a complete surprise, given the fact that Japanese policymakers have been talking about easing monetary conditions for some time in order to help get their struggling economy back on its feet, and at the same time limit Japanese yen gains. So I think the breakdown, the details of the announcement were a little bit of a surprise, but overall I think we were expecting some monetary easing from Japanese policymakers. Having said that, I think the market reaction, as you can see, as you mentioned earlier, was not exactly what Japanese officials would have hoped for. In fact, the dollar ended the day down against the Japanese yen. I think that's in large part due to the fact that market participants see similar monetary easing, if not larger, on a larger scale from the Federal Reserve when they next meet in November. So I think after everything is said and done, we'll likely see the dollar continue to weaken against the Japanese yen, despite officials' best efforts overnight.
Yeah, and what about the equity market reaction? Did you see the stocks rallying 2% in New York on expectations that the Fed will also ease monetary policy as well? Do you think that's likely to follow with another QE2 package on the cards? And what about the UK and Europe as well? There's talk that maybe they will follow suit.
Oh, yeah, with the stocks today, I think that was, again, largely due to the announcement from Japan, expectations that we'll see similar, if not larger, monetary easing from the Federal Reserve in November. We also had some positive data this morning in the form of the services sector, ISM, which I think highlighted the fact that the economy right now is in kind of a sweet spot where we're seeing it slow enough, essentially, to ensure that the Federal Reserve comes with additional policy easing in November, but not sluggish enough to raise the risk of a double-dip recession. So, again, I think that's definitely a positive for stocks. In terms of the UK, we've seen similar rumblings from policymakers in the UK recently. One official, in fact, earlier this week called for additional policy easing from the Bank of England. And so I think that sets up for a very interesting policy meeting from the Bank of England later this week. We'll likely see that officials are divided three ways, likely one official calling for additional policy easing from the Bank of England, one calling for actual interest rate hikes, and the rest of the policymakers essentially standing pat.
And Omer, what about the risk of policy mistakes? Because we have Nobel Prize-winning economist Joseph Stiglitz stepping in and talking about this expected round of quantitative easing coming from the Fed once again. He says that the irony is that the Fed is creating all this liquidity with the hope that it will revive the U.S. economy. And really all it's doing is nothing for the U.S. economy and causing chaos for the rest of the world. Do you think he has, I guess, some credibility in what he's saying here?
Yes, certainly I think there's a valid point there. I think following the Fed's most recent policy easing, we didn't really see any major improvement in the economy. In fact, really all we've seen is an increase in excess reserves in the banking system. So you could certainly argue that another round of quantitative easing or policy easing would only result in additional excess reserves in the banking system and not necessarily get banks to lend or improve the economy. So I think certainly there's some valid points there. The Fed, on the other hand, in its most recent statement, did clearly lay the groundwork for additional policy stimulus if the economy fails to improve. And so far, the data really hasn't shown any meaningful improvement in the U.S. economy. So I do think going forward, the Fed has kind of painted itself into a corner here where it's laid the groundwork, essentially paved the way for additional policy stimulus if the economy doesn't improve. And we really haven't seen that improvement in the economy. So I think the Fed, in the end of the day, is going to be forced to do some sort of policy stimulus when they next meet in November.
Okay, Omer, thank you for your insights. Nice talking to you today. Omer Esiner, Chief Market Analyst at Commonwealth Foreign Exchange.